Today, I'm talking with Shawn Griffith with Kraft Capital Investments. And I really enjoyed my conversation with Shawn because he has this unique experience of being a limited partner or a passive investor for many years before he got into the deal making side of the business. So I met Shawn at the Passive Investor event a couple of years ago. So if you missed this past year, shame on you. Check it out for next year in 2026. It is great. It is valuable and it creates connections with really good people. So Shawn just is going to bring a lot of practical advice, practical wisdom for those high income earners, business owners, entrepreneurs, and accredited investors. For if you are looking to make these investments, you're going to be a quote unquote passive investor. And we're going to talk about that in the interview today. Shawn has really good information to share with you, and he's someone that I think you should listen to. So if you need a little extra help with due diligence, first, go ahead and subscribe. There's going to be nuggets in each one of these interviews that I do. And then go look for that due diligence guide, how to use ChatGPT for due diligence to help you figure out what's buried in these PPMs. So without further ado, let's jump into the conversation with Shawn. Hey, Shawn, thanks for being here. I'm excited to hear some of your, not just what you're currently doing, but I know you have kind of a varied background. And I like to hear from people who they don't just do one thing or haven't just always done one thing. So why don't you start off and tell our listeners a little bit about your background?
Well, hey, Jared, thanks for having me on. I really appreciate you sharing me with your listeners. Um, wow, that's a long story.
Well, we
Let
got
me let
time.
me.
That's why we do this
Well,
long form.
yeah, yeah. I'll give you the abbreviated version because I'm sure we have a lot of things to cover
Yep.
today. Short version. When I was in high school, I enlisted in the delayed entry program in the
Mhm.
Navy. So I had a guaranteed seat at electronic school and nuclear power school. I also applied for a Navy ROTC scholarship. And I know you'll be utterly shocked to know that the government screwed up the paperwork on the scholarship. By the time they got it all straightened out, I was already through my ETA school. Anyway, long story short, they got it straightened out, went to school 4 years, commissioned, went to San Diego, did some more school there, went to my ship out in Pearl Harbor. Tough duty, but somebody had to do it. Actually, only spent about half the time in port. The rest of
Oh,
the
okay.
time we were out at sea. Did a couple of Westpacks. Did a tour in the Persian Gulf. Um, right after the USS Start got hit by an Exocet missile. Um, that's a whole nother story.
Yeah.
We weren't there when that happened,
Okay.
but we came in very soon after that. So to say that it was a little tense was an understatement. Um, got through all of that, got out, uh, was kind of at that point in the career where I either make a decision to stay in the Navy as a career or get out.
Hmm.
We'll just say the last CO I had was a non-people person and let it go at that. And so I got out and went home, was planning to stay in East Tennessee and where I grew up. Uh, but, you know, apparently the good Lord had other plans for me. I ended up going to work for Texas Instruments in Dallas. Worked for
Okay.
them for about 9.5 years until they sold their defense group to Raytheon. I worked for
Mm.
them for about another year and a half until they packed up and moved out of town. And then I did what I refer to as some creative unemployment. I did some access database babysitting for some small and mid-sized companies.
Okay.
And then I ended up on a contract gig at Southwest Airlines. Southwest hired me. They liked what I was doing and made me an offer. And this was in right around the January of 2001.
That was
Went
in
to
the
work
IT
for them.
space for them.
In the IT space. Yeah,
Okay.
I was working on their back office finance system. Matter of fact, Gary Kelly was one of my first customers. He was still CFO at the time, and then um, that was like at the end of March, March 30th, 2001.
Hmm.
And as we all know, 9/11 happened,
Yep.
and not too long after that. And I figured, hey, being the new guy, I'm going to be toast. Southwest didn't lay off a single person.
Mm.
It was really cool. Anyway, fast forward, I worked on the finance system for a while. I moved over into the reservation system. And then from there, I moved into production support and doing business and data analysis. Um, and then during that time, I got involved in investing in real estate as a limited partner. I'll go ahead and warn everybody now. I do not like the term passive investor. You as an investor should never be passive. The income can be passive all day long, but
Yep.
you as an investor have a lot of homework to do before you write me or anybody else a big check.
Yep.
Anyway,
No,
we'll move
I
on.
just saw a post from the CEO of Invest Clearly talking exactly about that. So yeah, Pat was a good Pat will be on the show as well. So that was a good one to see some of the info that he gets access to. So absolutely, I get what you're saying.
Yeah. Yeah, it's a big yeah, it's really just it's a mindset thing and I get it, but I'm going, yeah, if you call yourself a passive investor, you will become a passive investor. And you as the investor, nobody cares more about your money than you do.
Yep.
And I've been on and still am on both sides of the equation. And I get it. It's very easy if you get into a deal and you trust the people, it's very easy to just step back and not, stop paying attention.
Mm-hmm.
But there's still some homework you should do.
Absolutely. Okay, so that was your transition moving into single family. No, you said you started off as a passive
I s-
investor, so
yeah,
probably
started off as a passive
syndications.
investor. One of my friends had invited me to one of these weekend seminars. The first day they were talking about, oh yeah, you can get 10 single family homes and retire, blah blah, replace your income, blah blah blah.
Yep. Yep.
Well, being a math guy, I'm going, okay, probably more like 15 because you want to build a buffer in there, practical as well.
Yep.
And the next day they were talking about multifamily, and I'm going, ooh, that makes way more sense.
Mm-hmm.
I just didn't like the model they were doing, which was you only have one general partner on the deal,
Mm-hmm.
and that person's responsible for everything. And that's great if you get a good person.
Yep.
It's bad for a whole host of reasons. One of which there's what I call there's a sensitivity risk in there of what if something happens to that person that's the lead, who's going to step in and cover?
Yep. What
You
the
know,
hit by a bus plan? The we know.
exactly. Yeah, I was actually at a seminar in Pittsburgh at the Carnegie Mellon Institute,
Mm-hmm.
um, and Dr. Firth of the SEI was speaking about things like that, and he called it a bus sensitive project. He goes, if your
Bus. Yeah.
lead engineer gets hit by a bus and the project's going to go down the tubes, then you have a bus sensitive project.
Yep.
You don't want to invest in bus sensitive
I
projects.
a little bit of a side note, but very related. I have a uh, Jared gets hit by a bus document for my wife. And so it's who are insurance providers, where, life insurance, bank accounts, business entities,
Mhm.
which professional do you call to figure out X, Y, and Z? So, yeah, but it's the same thing. I'm doing it for
Yeah.
my family, but as the investor, you need to make sure that the GP that you're investing in has that plan as well.
Oh, absolutely. I tell investors all the time that should be one of the questions you ask the GP is, well, what happens to the deal if you get hit by a bus? And most of the GPs are going to go, I'm not going to get hit by a bus. I'm going, well, you don't know that,
Yeah, that's right. That's right. So,
you know?
okay, so they were teaching the model of investing in deals typically with a single GP, raising from 10, 20, 30, 50 LPs, limited partners.
Right.
Um, so did you do your first passive through that group, or did you,
Yeah,
kind
actually,
of?
my friend that invited me was ready to take the plunge. I was not.
Mhm.
He got a first. Our first deal was a little 64 unit over in Carrollton, Texas,
Okay.
and the guy absolutely crushed it. We got like 3.5 times our money out of it. It cash flowed 12 to 14%, and every day, every time I run into him, I look at him and go, "You bastard! You ruined me." I said,
And what year was that approximately?
that would have been like
Uh,
2012.
2012. That's what I was gonna say. I
It
mean,
If you could fog a mirror during that time, you could make money in real estate.
yep,
And
yep.
he's one of these people. He's what I refer to as a serial entrepreneur.
Hmm.
He's done a bunch of different things. He's failed miserably at a few of them, and a few of them he's done really well at. You
Yep.
know, real estate's been one that he's done really well at. He's pivoted now. He's investing in oil and gas. I actually invested in several of his deals, one or two of which have not done well. Um, uh, and then we've got one that's just absolutely crushing it, So one of the and that brings me to another thing that I like to tell investors is that I had an investor about 4 or 5 months ago ask me,
Mhm.
he goes, "What's your minimum?" I'm going, "That's the wrong question. You shouldn't
Yeah.
care what my minimum is. What you need to ask yourself is how big of a check can you write me, walk away from that money, never see it again, and it not materially affect your lifestyle or your retirement?" And his eyes got about this big. He goes, "Nobody's ever said that to me." I said, "Now, I don't plan on losing your money because my money's going to be in there alongside your money."
Yep.
But I said, you need to think about it from a personal risk standpoint of if this deal goes totally sideways,
Yeah.
will I be okay? I'm not asking you to be happy. Nobody's going to be happy about losing money, even if it's just a few percent.
Yep.
Nobody likes losing money, me included. But I said, you need to be cognizant of the fact that it could happen and adjust your investment size accordingly.
Yep.
Ideally, you should never have more than about 5 to 10% of your investment in any one single investment
Yep. Yeah.
ever.
That's some good info. Our listeners have heard Keith Blackborg speak. Keith says the exact same thing. Um, quick inserted shout out for the passive investor event is coming up in October. If we get this out before then, if not, check it out for 2026. So yes,
I went
Keith says
last
the
year and
same
it was
thing.
amazing.
Yeah. Yeah. He says, hey, and he even will break down some of the stuff between like he might say no more than like 5% per investment and no more than 10% per like syndicator or fund specific, which when I assume kind of when you're a syndicator, you might not love that as much, but at the same time, you got to step back and say, what's best for the investor, right?
Absolutely. I had one of my best investors that he had just put 200K in one of our deals. And he called me up and said, "Hey, I find myself with another, 300K I need to place by the end of the year for tax purposes." He goes, "Do you have
Mm,
another deal that's going to close by the end of the year?" And I go, "No," but I said, "I have a friend of mine that I invest with personally, and I'd be happy to make an introduction." And he goes, "You do that?" I go, "Absolutely." I said, "Wes, I would love to tell you you can only invest your money with me, but I said that's not smart for you, and it's not really good for me either because if I know I have all of your money, I'm going to be really nervous about you know having that responsibility." And I said, I try to tell people, I said, "Look, no matter, even if you find like the perfect deal and the perfect GP team, you don't invest everything with that one team. You got to spread it around.
yeah.
It's basic risk management."
Yeah. Absolutely. Because, and even because you can have a long track record of success and then they can still lose it all. I'm thinking about the ATM fund. In a group I'm in, they just sent an update in like yesterday. So this would be sometime in late August, early September, where they're talking about like the federal indictments coming down for a Ponzi scheme that I had multiple friends invested in because they had friends that were invested in it, and it's just you know what you're saying would have protected a lot of people's wealth if they had
Hmm.
not allocated significant portions of their investable net worth into a single investment.
Yeah, I mean, um, I we were invested in an LP deal, um, where the partners had, they're if I mentioned the names, everybody would probably know at least one of the names on the list. And they're good people. They have some successful deals scattered
Mm-hmm.
around different major metro areas in the country. Um, and I believe we got 9% of our invested capital returned to us,
Ooh.
which if you have trouble doing the math, I'll spell it out. We lost 91% of our equity on that deal.
Mm.
And these were known operators that have multiple deals. Um, it's just, everything lined up against them. And now, to their credit, they put together a post-mortem and shared it with one of the mastermind groups that I'm in,
Mhm.
um, and said, hey, here's what we learned from this.
That's a rough conversation to have.
Oh, it is.
Yeah.
It is. And they still look uncomfortable when they get up on stage and talk about it.
Yeah. Yeah.
And I told them later privately, I said, one, I appreciate it. And two, I hope you never get comfortable sharing that. Because I mean, because you shouldn't,
Yeah.
you should never have to have those conversations. I said,
Yeah.
I mean, everybody's all about, on the front end, telling about all the great things about real estate, like, you know, um, long-term wealth creation, capital appreciation, the tax benefits. One of the things that I hear almost nobody talk about that real estate will teach you, that is patience.
Oh,
One
yeah.
way or another, real estate investing will teach you patience.
Yeah, absolutely. Okay, so we went on a tangent, but a good one. So you did your first deal. It was a killer deal. You are now sucked in.
Yep.
What did the progression of you being a limited partner or um, passive investor, for lack of a better word, what did that look like the next couple of
So
years?
we got we got involved in a few more LP deals.
Hmm.
Um, and then if you fast forward to November of 2020, my wife and I were kind of sitting around the kitchen table talking about our finances and what retirement was going to look like.
Hmm.
And we go, yeah, we'd have an okay retirement, but who wants just okay? Uh, my wife has enough destinations picked out for us to travel probably 6 times a year from now until we're in our 80s,
That's
maybe
my wife's
longer.
going to get there pretty quick. Yeah, no, I feel you on that.
Well, so we should probably not let our two wives
Yeah,
talk to each other. That could be expensive.
yeah.
I mean, we're going to Africa in November.
Mhm.
We're going to be gone for a little over 3 weeks, like that,
That's
almost
yeah.
almost the whole month of November.
My in-laws did that recently. Had some really cool photos.
Yeah, that's my job is carry the luggage and take pictures.
There you go.
Um, I jokingly refer to myself as the Sherpa. Uh, but we're going to like Kenya, Tanzania, and Rwanda,
Okay, very cool.
and then she just booked Botswana for next April because there's some other stuff she wanted to see, and she goes, "Well, since we've already got all of our shots and everything, it makes sense. Let's just go ahead." And
Yeah.
I said, "Perfect." But that's going to be my birthday trip.
All right. So you were figuring out how you're going to pay for all your trips.
Yeah, yeah. So we were talking about the finances and what can we do to kind of juice the returns on
Hmm.
everything. And we looked at several options. Um, and for us, syndicating real estate really made sense because we had a good experience with real estate.
Yep.
Um, we found a coach and mentor, joined their program in March of 21, dove in head first,
Okay.
closed my first deal as a general partner. Excuse me. Um, Closed our first deal as a general partner in November of 21,
Okay.
which some people say that was kind of the beginning of the end. Um, I just did a distribution on that property last month.
Awesome.
Uh, it,
That's almost
eh,
almost surprising to hear with the other stories
well,
we're hearing right now.
I've only missed one quarter, and that
Okay.
was just out of an abundance of caution when things were starting to get really ugly. I just sent an email out to the investors going, "Hey guys, we're gonna take a pause on distributions this month. We have some potential expenses coming up. Some roof work that we needed to do. I didn't
Yep.
know if it was going to be 25K or 125K. You just never know." But and then the next quarter we started distributions
That's
again.
great.
This property now, the saving grace on this property, fixed rate debt. I
There you
tell
go.
people, I said, debt's great. It's like a power tool.
Hmm.
If you don't know how to use it properly, you could lose a limb. And you know, it's one of those. It's like any other tool. You just need to know how to use it properly. I'm not a fan of bridge debt or floating rate debt. Both have their purpose.
Yeah.
We closed on a deal last February. We got a 3-1-1 bridge loan, floating
Okay.
rate debt. We bought the 3-year rate cap right out of the barrel. That's because I told my partners, I said, that's the only way I'll sign on the loan is if we have the full 3-year rate cap up front. I said, it's not an option.
Yeah.
And they go, no, that makes sense. It's a risk reduction thing. And that property, we've owned for, it's coming up on 18 months.
Yeah. That's not,
Um,
yep.
we're planning on doing our first distribution this quarter.
Okay.
It was a heavy value add. We put a little over $3 million into the property. Um, so, we're not afraid of ones that are, the ugly ducklings that we can come
Yeah.
in and clean up, and we fully expect to refinance this property first quarter or possibly second quarter, depending on what the rates are doing,
Okay.
and return 20 to 40% of investors' capital.
Okay.
And then we'll continue to hold it for another probably 5 years, potentially. Um, and
So a
and and
little
just
longer hold than a lot of the coaches were coaching in 18, 19, and 20.
oh
Maybe
yeah,
5 to
everybody was
8 year
teaching the
hold.
5 year,
They were
you
teaching,
know,
yeah, 2 to 5 years, right?
or 2 to 5 years. Yeah, yeah, and that's okay in a strong up market.
Yeah.
Real estate is cyclical, and it's not good to have that. If you do one property like that and then you buy your next one with the intent of holding it longer, I think you're better off. Um,
Yeah.
you've got to balance
Some
strategies and
staggered
everything. Yeah.
options. Yeah. Okay, so that was that was 21 when you bought your first property.
Yep.
Roughly how many passive investments would you say you did before you jumped into the GP side of the deals?
Probably a dozen.
Okay. Yeah, that's a lot more than most people.
Yep.
I hear people talk about how they're in like 40 or 50 deals. I'm like, how much money did this person have when they started? Uh
Oh, one of my favorite investors, and I referred to him as a uh, uh, professional passive investor. And he goes, no, no, no. He goes, I prefer the term serial passive investor. He says, because to be a serial murderer, you've got to kill more than one person. He goes, so I'm a serial he was invested in, I think he's up to 77 deals now.
oh my gosh, yeah. I mean, essentially, and this is one of the things that I've learned over the years, is like he's probably viewing his own wealth like a business at that point, right? The amount of time and
Hmm.
energy and effort that it takes to properly manage that is real. You can't, like you said, it's not passive. You can't just
Oh
throw your
yeah.
money
I
out there
mean,
and
and
wait.
And what's really cool is you will rarely see him at an event where he doesn't have a little white uh, 3-ring binder that has all of his deal stats in it for every deal he's ever invested in.
Oh, that's impressive.
And well, he's a retired engineer,
Sounds
so
like an engineer.
he's into the numbers, and that's if he's in a deal, I guarantee you all of the general partners know his name because he
Yeah.
asks, he will ask the hard questions,
Yeah. Yeah. I've been
as he
the
should.
correct. No, I've been the guy that's asked some questions that make people laugh and they say, "Well, thanks for asking it." But it's just like, even sometimes you see something on someone's resume, it's like, "Hey, Harvard Business School." It's like, "Okay, well, like that should be pretty verifiable." Well, those schools won't verify anything without like very specific information, right? So then
Hmm.
sometimes you got to go back to the person and say, "Hey, I'd like to verify this myself. Will you give me this information I need?" And it can be a little uncomfortable to ask those questions because you're essentially saying, I'm not taking your word for it. I mean, it doesn't have to be a negative thing, but like you got to do your own due diligence because
Yeah.
you are marrying that person when you invest with them.
Oh, I the, I will tell this to all the investors. The term limited partner, the key word in there is partner.
Partner.
You are still a partner. The limited part means you're only going to be liable for whatever your invested amount is. That's the
Yeah.
most you could ever lose. Now, you are, as a partner, you have not only some rights, but also some responsibilities. And a lot of people don't even talk about the responsibilities of what their investors have. You have the responsibility to keep your contact information up to date with whether it's in a portal or manually.
Hmm.
I think pretty much everybody uses some kind of portal now. I'm a huge fan of Cash Flow Portal. I'm probably their number one raving fan. Um, and just also for transparency,
Yep.
I'm an investor in the company, a
There
very
you go.
small, I'm probably the smallest investor in the company, but again, still a raving fan. I know Perry Zing, great guy, excruciatingly smart, has some big plans, and I'm looking forward to that company, growing and
Yeah.
continuing to add new features and things like they do every day. But anyway, responsibilities of the investor, that's just one of them. You got to keep your information up to date. Keep your bank account information up to date. Like if you change banks or you move, your address changes, your phone number changes, we've got to be able to get a hold of you as if I'm a general partner and you're one of my investors. And again, that's one of the things I also hate to say is I know you're not my investor. You are an investor in our deal, and we
Yep.
appreciate that you trusted me enough to invest with me.
Yep.
Again, it's one of those mindset things, right? We all refer to the investors in the deal as my investors or our investors. Well, they're not really.
Yeah.
But you as the investor have some responsibilities, to keep us aware of what's going on. I've seen all kinds of issues, you know, uh, where people, like they invested and they sent the money from the wrong account. Well, that's on their side. I have no control over that. Now, as a GP, there are things I can do to help fix that. I've had to change from individual investors to investing from an entity.
Yep.
We've had one investment where there was a divorce and we had to make it two investments. So, I mean, you see all kinds of stuff, but
Yep.
you as the investor, we have to be kept aware of that. If you don't tell us, we don't know, and you're going to get a K1 based on the information we have on file, and the distributions are automatically going to go to the bank account that we have on file, and
And they're going to get reported under the legal entity that you have on file.
yeah, exactly. So it's a two-way street. It's a two-way
Yeah.
street.
Well,
Don't
let me
forget
ask
the
you this.
partner part of limited partner.
Yeah, the partner part. What's, you know, what I really want is actionable information for these limited partners. But what I want to get from you, because you have a little bit different experience than some of the guys we've talked with, who maybe they weren't really um, LPs prior, or not LPs for a long period of time. So after your transition to being a general partner and syndicating deals, where would you say was your biggest gap in knowledge or things you wished you had known better when you were a limited partner or a passive investor?
Oh wow. Um, well, the gaps are huge. Um,
Because those are probably the same gaps a lot of our listeners might have, right?
Yeah, oh, yeah, I'm sure, and there's probably some general partners out there that still have some of those same gaps. One of the things you've got to remember about real estate transaction is that no two of them are ever the same.
Hmm.
80 to 90% of the transactions going to be pretty much the same from transaction one to transaction 10 to transaction 100. It's that other 10 to 20% where the deal could either be made or blown up. And the general partner's job is to work through all of those little subtle things. It could be anything. So I'll give you a prime example. We have a deal in flight right now.
Yep.
It's a small property. It's 104 units here in the DFW area. And no, I'm sorry, you can't invest in it because we were very fortunate that we announced the deal, and then 5 days later, we had to start putting people on the wait list.
Awesome. Good problem to have.
It is a great problem to have. First time I've ever had that problem, I was ecstatic. But one of the things that we were dealing with is this property was owned by a trust. I won't go into the whole. There's a whole nother long story behind all of this. Anyway, suffice it to say that the person running the trust was not very familiar with real estate transactions. transactions, and
Hmm.
so everything had to go through her lawyer, and that just slowed the process down. Well, we found a leak day one of our due diligence, and then now we are nearly 60 days into the process. They fixed a couple of the big leaks, but they still haven't fixed everything. And it took them over 30 days to find the first leak and fix it, even though we pointed out where it was.
Yeah.
So part of the GP's job is to go through and look at all of these things and kind of figure it out. And all of this goes back to the private placement memorandum, which I recommend everybody should read,
Yep.
or at the very least, put it in ChatGPT and ask it, you know, is this investor friendly or is it GP friendly?
Yeah.
Because you need to know. And if
And
it's
insert, I have a how to use Chat GPT guide in the description below to help you give you a good running head start on how to use that for PPM. So thanks for that softball right there, Shawn.
Hey, absolutely. I am huge on using AI. As a matter of fact,
Yep.
I'm giving a talk at a conference next week uh, on how Kraft Capital is using AI
Oh, that's great.
to grow and scale its company. I'm speaking at a veterans event next Friday and Saturday. So if anybody's in the Dallas area, feel free to reach out to me. I'm happy to, connect you with that veterans group because
Cool.
they're always doing events. But anyway, that whole process, going back to the PPM, there's about 14 or 15 pages. All are reasons you should not invest in this deal.
Yep.
You know, fire, flood, famine, hail, locusts, you name it. If it's ever happened, it's in there. It's
Yep.
kind of like you're reading your medicine bottle for all of the side effects, right? Um, and the first time I read it, it scared the crap out of me. And so my friend that I invested with on our very first deal, he goes, I'm not an SEC attorney. He goes, you should really sit down with an SEC attorney and have him review this with you. And so he gave me a couple of recommendations. I
Hmm.
called the guy up and said, hey, this is what I have. This is my first one. I'd love to have you walk me through it. I said, first, I want you to tell me, is it a valid document or not? Does it do what it's supposed to do? And two, explain it to me in English. And he said, sure, I'll do that. Flat fee, $500. Best $500 I ever spent.
That probably
Ne-
was, man.
oh, well, now he wouldn't even do it for $2,000.
Yeah. Yeah.
I'm not even sure he'd do it at all. He might have one of his minions do it.
Correct.
I jokingly refer to his office staff as his minions.
I have a good buddy from church who is a partner in a law firm. And when I need something done, he says, hey, I'll have my assistant do as much as possible. I'll review it at the end. And so I'll have like a 30-minute or a 1 hour charge from him and like 4 hours from the assistant, and they're
Yep.
equal. This is
Yeah.
so,
Yeah.
yeah, I get it.
Yeah. No, that's, yeah. But anyway, he said the only reason these 14 or 15 pages should scare you is if they're missing,
Yep.
because then they're hiding something.
Yep.
He goes, what these 14 or 15 pages of reasons you should not invest in this deal should do is cue you to go, hey, Mr. or Mrs. Sponsor, how are you mitigating all of these risks? And about 80% of them, it's just having the right amount and type of insurance. The other 20% is doing a very thorough physical due diligence. And
Okay.
and really those are, doing the due diligence and getting the right insurance. Those are things that, as an LP, I didn't know. It's all stuff
Yeah.
that happens behind the scenes. And there's so many moving parts and so many things that a GP needs to know. I don't see how one GP does everything because
Mm.
like I said, there's a lot of moving parts.
Yeah. Yeah. You can't be an expert in everything.
Mm-mm.
Okay. So since you're talking about the PPM now, this is a great time to ask it. What are some red flags specifically that you would find in the PPM for a passive investor to kind of look out for or to question?
Well,
Let's call it yellow flags, because maybe a yellow flag could just mean you need to know this, and a yellow flag could go either way. You just need to understand it.
well, I mean, you need to understand the core pieces of the PPM and what their purpose is, right?
Mm-hmm.
And this can kind of go back to that Chat GPT. You know, if ChatGPT is doing what it's supposed to, it will tell you it's not there to give you legal advice. But if you give it a PPM and say, "Hey, I want to understand this document,"
Yep.
um, and summarize the major parts and tell me what purpose they play, now you have an understanding of what the different pieces are and why they're in there. Some of them are to protect the general partners. Some of them are to protect the limited partners. Some of it's to protect the lender. Now, a lot of that goes into, and that's a whole nother topic in and of itself of, you know, gaps of, well, like who is the lender? And what, um, what type of debt does somebody have on the deal? Again, none of that's going to be in the PPM. All the PPM is a it covers it's just an offering of securities to you, the investor, and the vanilla definition of a security is you're going to make money off of somebody else's effort. That's just
Yep.
that's what it boils down to. There's a more complex definition, but that's really what it means.
Okay. Okay. Now, what about when it comes to maybe whether it's fees or limited partner rights, or what are some areas of concern that that an investor, especially a new investor, right? We may have a lot of people who are not these serial passive investors, right? So
Right.
if there's a couple of items that are like, you need to find these items specifically.
Hmm.
Okay, we understand what's happening. We understand the investment. We understand what they're telling us. Okay, it's a value add apartment complex. It means we're going to renovate it.
Right.
What are the couple of fees or rights related concerns that they should be looking for in the PPM?
So you want to look, and this would be one of those things, a great use of ChatGPT, and I suspect that you've already worked this in, is show me all the fees and the different ways the general partner teams get paid in this deal. Acquisition fee is usually number one. What's normal for the market is anywhere from a 0.5% to 2%. 1 to 1.5 is pretty normal. If it starts getting north of 2%, I would question uh,
Incentive
why.
structure?
Yeah, yeah, I would question the incentive structure, because that means that the GPs are going to probably end up with close to zero money or less than zero money actually in the deal up front.
Yep.
And I get why teams do that, because at some point you run out of your own money to invest in deals. None of us have an unlimited supply of money.
And if you did,
Now,
you wouldn't be working.
well, exactly, exactly. I have to. And fortunately for me, this is my work, so this is what I
Yep.
do. So acquisition fee,
Okay.
asset management fee.
Okay.
Again, 1 to 2% is pretty normal. If you see anything bigger than that, red flag. You really need to dig in and understand why. The other one is a construction management fee. So if you've got a heavy value add, you'll see like 6 to 10% in there. Seven's kind of normal. If it starts creeping above seven, I would be, again, concerned. It might be a yellow flag.
Mhm.
If it's 10%, that's a red flag. There might be some other fees in there, like a refinance fee. Some people argue on whether that is valid or not.
Yeah.
Several loans with lenders now, it's a lot of work and it's a pain in the ass. So I don't mind charging investors a 0.5 to 1% refinance fee.
Okay.
Anything above about 1%, I would question. Um, Sometimes there's an exit fee. Um, and I'm going, yeah, there is some wrap up stuff, but the GP shouldn't need an additional fee in addition to whatever they're getting as the GP share.
Yeah.
And that's another thing you want to look at is what's the split on the upside. Are investors getting 70% and the GPs getting 30 for their carried interest? Is it more like 80-20, 90-10? If it's 60-40, I would run, not walk away from that deal. And again, there's always exceptions.
Correct.
you know every deal's different. If they're doing a 60-40 split and you're still getting like a 20% IRR and it's going to cash flow 8 to 10%, maybe that's worth it to you. Again, this is one of those things you as an individual investor need to assess the deal, and the question you need to ask is, does this fit my investing thesis?
Yeah. And that could be not even just deal to deal, but industry type, like investment category, which is something I've also learned from some of these investor groups, is what's right for me may not be right for my parents or right for you, just because technically we should have different investor profiles.
Yeah,
The more different you are in life stage, in income earning life stage, the more different your profile should be, right? Well, and then your actual investable assets. You have no investable assets, or very little.
absolutely. I'm
Yeah.
I'm at that stage in my life where I'm obviously a little more chronologically gifted than you are.
Chronologically gifted. I like that. I'm chronologically disadvantaged, as that old Ronald Reagan quip he had. Won't
Yeah,
hold
yeah,
his opponent's inexperience against him. So
yeah, yeah. But no, that's one of those things that you know, as a prime example, one of the other things that we do at Kraft is, besides multifamily, is we're expanding into alternate assets because we've
mm,
had some of our investors go, really, we want some other investments outside of real estate because we still love real estate. We still like the thesis of
yep,
owning real estate. We just want to diversify some more
yeah.
stuff.
You want some
And
non-correlated assets.
exactly. So we've got a very niche triple net deal that we're looking at, and that's going to focus on cash flow because a lot of our investors go, we really miss the days of real estate where we got that 8 to 12% cash flow. And me too. I miss that.
Yep,
I'm at the stage of my life where if an investment doesn't cash flow, there's a 99% likelihood I am not going to invest in it.
yep,
One of our other offerings, we're actually looking at a small batch bourbon um, company where we're gonna buy barrels of bourbon. There is zero cash flow in that.
yeah,
You buy barrels, they sit in a warehouse, and in 2 to 5 years you sell them. And there's zero chance of, well, I won't say zero, maybe a 2% chance of cash flow if we end up selling off some of the smaller batches.
okay,
But there's I'm probably, I mean, I love the deal. I went up and met with the team that we'd be buying barrels with and investing with. And great people, love them to death, very knowledgeable, but there's no cash flow.
yep,
So, if somebody's looking for something that's strictly a capital appreciation play outside of real estate, this would be great. But for me personally, I mean, even though I love the deal, I'm not going to invest in it because it doesn't meet my investment
yep,
thesis.
yep. Okay. Um, okay. That makes sense, and I think that's something that a lot of people struggle with. And I call it shiny object syndrome. Everything that comes across your plate, you want to look at, you want to consider, you want to figure out how to make it work, and is it right for me? And sometimes you don't need to work real hard to figure out it's not for you, right?
Yeah.
Is if you just have your own parameters set up in advance.
I would tell people, don't ask, how can I make this work? Start with the question, does this match my investment thesis or my investment
Yep.
goals? You know, Without changing anything, does it fit in? And if the
That's
answer is no, move on.
that's
If
the
it's maybe, then you go spend some time on
yeah.
it. But yeah,
That's almost exactly what one of my mentors told me in the single family space. Because I'd call him occasionally trying to brainstorm ways to make a flip work. And I think he said almost exactly that. Jared, you can't try to make every deal work. It's almost like you gotta look for the reason it doesn't. And as soon as you find it, you're done. Like just quit it. Because
well,
I'd beat these deals up on a spreadsheet for hours and hours and hours. And at the end of the day, I just wasted 4 hours of my time.
yeah, and when we buy multifamily properties, we go in when we do due diligence. we've already put down earnest money because, everybody expects earnest money. Now, what we typically will do, um, is we'll only put down 50% non-refundable,
Yep.
and the other 50% is refundable up until we finish the due diligence period. And we dig into everything. I mean, we look for reasons to get out of the deal.
Yep.
Now, typically we don't want out of the deal. We've already
Yeah.
done as much diligence as we can before we even get it under contract. But once it goes under contract, we're still looking for any hidden landmines.
Yep.
Like we had the property that we're closing on next week. Um, it has two water meters on the property. One of them was running about 2 to 3 gallons a minute. The other one was running 22 gallons a minute.
Ooh.
And this was in the middle of the day when we were out doing due diligence. I'm going, even if you had like everybody in the apartment taking a shower at once, it's probably not going to go that fast. So anyway, we, like I say, we shared that with the current property management
Yep.
company, and it took them 30 to 45 days to get a handle
Okay.
on it. Even
That
though
was
we
the one you
pointed
were
out,
talking about.
yeah, even though we pointed out where the leak was on day one of, or I think it was day two of due diligence that we
Okay.
actually found the leak.
Okay. All right.
We knew
So
there was a leak day one.
yeah, that's and I have mixed feelings about most property management companies, Um there's some good
Well,
ones.
this one is really because of the owner, because it was owned by a trust and everything had to go through the
That's
lawyer.
right.
And
Okay.
there's some other backstory to that we don't have time to go into because that would be another 2 or 3 hour discussion.
Well, I want to ask you, you mentioned the first one you bought in 21. You're still buying stuff now. I know on your website, you've got craftcapitalinvestments.com. We'll include that in the show notes. But you show that y'all were buying from 21, 22, 23, 24. Tell us what that life cycle of buying through this transition has been like.
Some days it was kind of brutal.
It's a loaded
Uh,
question there. Yeah.
yeah, yeah, no, it is. I mean, and it's a great question. Um, you know, 21, there were still deals out there. 22, you started seeing the volume drop off. And just so your listeners know, we focus exclusively in the DFW area.
Mm,
There's a section between Dallas and Fort Worth called the Mid Cities, Hurst, Euless, Bedford, Arlington, Grand Prairie.
yep.
We like that area. That's kind of our area. And we look for, older properties that are value add. So there could be something new that comes on the market that was built, in the last 4 or 5 years. We're not going to chase it because the institutional money's going after that, and we're not in a position to compete with like BlackRock and
Yeah.
Madeira Residential and SPI, some of the big players in our area here. Um, but yeah, I mean, we started in, I guess, 21 developing broker relationships. Anytime, and this is one of those things that a good friend of mine, Mike Guthrie, gave a presentation at one of our coaches meetings last night, as a matter of fact. And I'm going to read this quote. It says, "The foundation of influence is found through creating value."
Mm,
And everybody's always asking the brokers, "Hey, can I take you to coffee? Can I take you to lunch?" And
yeah.
lunch
There's
is
no
usually a
value in that
waste.
5 or 10 or $20 thing you're offering. Yeah.
No.
Not for a successful one.
And the right question you should be asking the brokers if you're looking to develop that relationship is, aside from me bringing you a deal for you to sell, how can I help your business?
Mhm.
And and let them put the ball in their court and see what they tell you. Most of them, it's hey, if you will come tour this property and put an LOI in on it, because during that time frame they were begging people to come and tour properties and submit LOIs. They knew they didn't have to beg us if they asked, and it was a property, and I mean, and we'd tell them and go, this is really outside our buy box, and they go, we know, but would you please come look at it and give us, and we would actually underwrite it and give them a number and our rationale for that number.
Yeah.
And and we knew we were never going to get it at that price because we're value add guys, and this wasn't a value add property. So anyway,
Yep.
part of that is we invested time that helped the brokers, because now they can say, well, hey, we had 4 people tour the property last week, and we've got 5 or 6 people have submitted LOIs so far. None of them are numbers you want to see, but we'll
Yes.
present them to you.
100%. It helps them justify what they're doing to the seller. If it's
Yep.
overpriced based on the market conditions,
Yep.
it gives, that proof. And I'll be honest, I'm a single family broker. I'm not a commercial broker, but I say the same thing. I'd rather have a low offer than no offer, right?
Yeah.
At least it lets the seller have some information and make a decision.
Well, it's an indicator of the market, right? And I would caution people to not lowball just for the sake of lowballing. You need to have a rationale for your number. You know, for example, like a single family, if there was a nice property and it was on a corner, and I knew across the street was going to be leveled and turned into a uh, truck parking lot, I might offer less on it than if they were going to build a Walmart across the street.
Mhm.
So it's all about doing your due diligence ahead of time before you even throw an LOI out.
Okay. All right. So building relationships with brokers, you were doing that early in your
Yep.
transition. So 21,
Yep.
22. So you were starting to see the transition happen a little bit at that time, right? And is that why brokers were getting more, hey, just come look at it.
Yeah. Well, when you say transition, it was the downhill slide of the market.
Yes.
Yes. So just to make sure we're both understanding the terminology,
Yeah, yes. The market was getting
transition.
worse for property owners.
Yes. Transitions just means change. This was a negative change. So yeah, it was.
Yes, yes.
Yeah. Yeah. So the great thing about the English language, is you can say
Yeah.
things. I
Yeah.
mean, but I mean, what do you expect from a language where you drive on parkways and park on driveways?
There you go. Yeah.
Anyway, yeah. So yeah, we were building those broker relationships. We were honing our underwriting skills. We were still underwriting a lot of deals at that point.
Mhm.
Um, Not just in our area. We would underwrite deals because we had access to deals from outside of DFW. We'd underwrite them just for practice.
Okay.
As the deal flow started picking back up around into 23, I guess it was really kind of early 24, deal flow
Okay.
started picking up a little. Um, from 22, 23, and into probably the first half of 24 was kind of that big downhill slide. And really here, middle of 25, I really feel like we're past the bottom now.
That
Now, whether
sentiment I'm
we're
getting from other multifamily guys as well.
yeah.
That
Now,
now might be the time to jump back in on buying, but it's hard. It's hard to, push that message well just because it's still so raw.
oh yeah. I mean, I have one of my investors in one deal that I believe they lost over $2.5 million in
Oof.
the last few years. So yeah, they're not happy campers.
Yeah.
They will not invest in real estate ever again, I'm pretty sure.
Yeah, but that's what can happen. And actually, I want that's a good lead into my next question. Tell me about some of y'all's recent purchases, and maybe a little bit more about like what did that deal look like, not just from from your side, but like what was happening on the sell side. Are you also buying some properties where basically all the LP equity was wiped out, and you're basically buying a property for the debt? I've seen some guys say, hey, like they're looking at properties, and if they're able to buy it, that's basically what the offer is now. I mean, again, that's going to vary property to property, but what are some of these deals look like that you're trying to buy or have bought recently?
We bought a deal February of 2024. I'll give you the short story on that one. About 3 years ago, it came on the market for 27 million. We underwrote it at 24, submitted an LOI. Were not invited to best and final. The guys that won the deal um, couldn't get financing to stick because that's when interest rates were still going up.
Okay.
Deal fell apart. Seller took it off the market, brought it back on about 3 months later for 24 million. We underwrote it at 21 and a half. Submitted an LOI. We were invited to best and final. Still didn't win it. The guys that won it spent 3 months negotiating the PSA. And for the
Hmm.
listeners that may not be familiar with the commercial real estate process, 2 weeks is normal for negotiating a purchase and sales agreement. 3 months is insane. Broker came back to us and go, hey, is your all's $21.5 million offer still good? And we go, it's been 3 months. Interest rate environments has changed. Send us the latest financials. We'll get you an offer. They got us the financials. We gave them an offer. They accepted it. And that was July of 2024. And no, I'm sorry. That was July of 2023.
Okay.
And February of 2024, which was last year, we got the deal closed. So that was 8 months and 7 contract amendments later, we got the deal closed. So that was a mental and physical beating. My
And it
partner
was
and I,
millions of dollars less than your first offer.
oh
Your very
yeah,
first LOI. Yeah.
yeah, yeah. If they had accepted that $24 million offer, they'd have been sitting good.
Okay. Yeah.
Um, but you know, it, like I say, and this is the property I was telling you that we did a little over $3 million in rehab on it.
Okay.
So it was an ugly property. Um, you know, when we took over on a Friday
Hmm.
and Saturday, we had, I believe, 7 different crews on site working on everything imaginable.
Okay.
We'd actually hired 3 extra full-time maintenance guys to come on and literally go door to door and ask people, what do you need fixed right now? And because there were over 250 maintenance items backlogged that had never been handled.
Oh my gosh. Was
And
that
we
a
just said,
long time kind of like mom and pop owner, or was that a group that owned it that just, milked it for whatever they could and didn't put any, CapEx into it or
neither
maintenance?
actually. Um, we actually know the seller, and my partner Gabe, who's a consummate negotiator, got the guy to invest back in the deal as an LP. He's a good guy, normally a really good operator. He just ran out of money. And
Okay. Okay.
anybody that owns a business knows the worst thing that can happen to your business is you're undercapitalized. You run out of money. And because I mean his hands were kind of tied. I
Yeah.
mean, the day that we showed up to do due diligence, there was somebody from the city there slapping a big red sticker in the window that said, warning, by order of the city of Bedford, stop leasing. They were not allowed to lease until they got a bunch of this stuff taken care of.
And so did that happen because they had an adjustable rate mortgage and their payments skyrocketed or just various other reasons?
I think it's just various other, I think they went in undercapitalized
Okay.
and they made the assumption, and again, this is all
Yeah.
my
Yeah.
supposition. I think they assumed they were going to be able to raise rents like they had been doing, and then cash flow was going to cover anything
Yeah.
that they needed, and that was not the case.
Okay. Okay. Yeah. And that's, one of the things is, have you come across, I'm sure you have, tell me what you're seeing on some of these deals that you might be underwriting. Are you frequently seeing deals where, I don't know how much transparent data you have, but you're basically offering what the debt is on stuff, or if you were writing an offer?
So a lot of it depends on obviously the seller.
Yep.
Do they have to sell or not? Uh, if people are in a position they can continue to operate the asset and the asset's paying the bills
Yeah, if it's
and they
paying the
can
bills.
keep up, yeah, and they can keep up with the maintenance, they're not selling
They
right
should
now.
not be selling, correct?
Now, there are a few exceptions. And we've seen one or two of those where, the guys have held the property for so long, they've met their numbers and they're ready to get out.
Hmm.
And, we could pick it up, but it's not going to be a great deal.
Yeah.
We're looking for those, we're not looking for singles and doubles. We're looking for triples and home runs. And when I say triples, that's not going to be triple your money. That's
Yeah. Yeah.
you,
A really
you,
good deal.
we're looking
Whatever
for
that.
a really good deal. Yeah.
Yeah.
The one that we bought February of last year was like mid 70s a door, um, which is
Not
a
bad.
really good deal.
Yeah. Yeah.
Um, this one that we're buying from, it was a 28-year owner
Okay.
that he passed away and it ended up going into a trust. Um, that one we're getting probably, the high 70s a door.
Okay.
So, we're looking for that low hanging fruit. Um, and brokers will bring us deals that they know are like that because they know we like them.
Yep.
They also know that if we go after a deal, we will close on it, which
Yep.
as a broker, that certainty of close is huge. We will do whatever we need to do, whether it's bringing in additional investors or, putting more of our own money into a deal, whatever it takes to get it over the finish line, we will
Yep.
close.
Yep. Okay. All right. Hey, we're gonna start wrapping it up. I got a couple more questions for you, but
Sure.
one, I want to loop back and just say, hey, I know we've already talked about some either red flags to look out for or things that you wish you had known. But if you had to give one or two additional warnings or words of advice to a limited partner or someone considering making an investment into a PPM, give me your last bits of parting wisdom on that.
So, it's hard to just sum it up in one or two things because there's so many. I,
Yeah.
I I mean,
Give me
and I
bullet
hate to,
points then. You can give me more than two. That's fine. We got
well,
time, and
and
we're
I
not in a
hate to
rush.
generalize, but
Yeah.
the short version is do your homework.
Yeah.
You are not a passive investor. You are a limited partner. Emphasize on partner.
Partner.
Um, and there's homework you need to do. Um, Investing is work. And the bulk of the work as a limited partner should be done up front.
Hmm.
You shouldn't invest your money and then go do your homework because if you find out later, oh crap, I shouldn't have invested with these people, well, it's too late. Because especially with real estate, because real estate is inherently illiquid, which means you can't get your money tomorrow or next
Yep.
month or even next year. And then also to generalize, I don't care what you're investing in,
Hmm.
you need to understand it. And whether it's the stock market, oil and gas, crypto, real estate, cannabis, I don't care. You need to be able to answer two fundamental questions. One is, how does this thing make me money? And two, how can this thing lose me my money?
There
If
you
you
go.
don't understand the answer to those two questions, go back and do more homework.
That's good. If that's all someone heard today, that alone would be worth the time they spent listening. Is understand how it makes you money, understand how it could lose you money. I have made the mistake of not answering the second one and thinking that the downside was worst case scenario, I get my money back. And I was wrong. So,
I'm right there with you.
yeah,
So that I have learned that the hard way, and I am happy to share it. One thing my daddy always said, mistakes are okay as long as you don't keep making the same mistake over and over. And the best mistakes to learn from are somebody
other
else's.
people's. That's right.
Yep.
Other people's mistakes. That's right. We talk a lot about other people's money in real estate investing, but other people's mistakes are a great one too. So,
Yep.
okay. Well, Shawn, I know you mentioned, and let's make sure I'm right. You do not currently have an investment opportunity that someone could invest in. Is that correct?
Not for real estate.
Okay. Well, what do you have just overarching, and then we'll give them the best contact information for you.
Sure. We just went live with our triple net fund.
Triple net. That's right.
Um,
Okay.
yep. And then our small batch bourbon should be coming online maybe in the next month or so. We're
Okay.
still wrapping up the due diligence on that.
Okay, great. Now, if they want more information on either of those opportunities, what's the best way to get a hold of you?
Uh, Go to our webpage, craftcapitalinvestments.com.
Okay.
There's a contact us tab up there, and that'll take you to a page that has my calendar, Gabriel Kraft's calendar. And so
Okay.
we're happy to have a conversation. Um, my email's on there, my phone number's on there.
Perfect. All right. Well, we'll put that in the show notes and in the description, so it's easy for people to find you if they want to. So, Shawn, thank you so much for being here. Not only did we learn something today, I really enjoyed the conversation. So this was great.
Likewise, Jared, I really appreciate you having me on. And as you can probably tell, I could talk about this stuff all day long.
There you go. All the good people can. So it's good to see that.
Okay, so one of my biggest takeaways from this conversation with Shawn is I should not be thinking of myself, and you should not be thinking of yourself as a passive investor, but rather a limited partner who does have responsibilities. So if you enjoyed this conversation with Shawn, feel free to reach out to him. He is a great guy. I do like him a whole lot. And if you haven't done it yet, I'm going to remind you to hit that subscribe button. And if you're looking for a little extra help with due diligence, download that free guide in the description below. I'm looking forward to connecting with you next time.